Quiet now, everybody. Quiet, listen to me. We're going to start a show. Now, some of you people have been with me before. You know it's going to be a tough grind. You're going to dance until your feet fall off. You're not able to stand up any longer. But we're going to have a show.
Welcome to The Debate, and welcome to the Pink Door Podcast. Today, we are diving pretty deep into the latest real estate market trends for Marshfield, Massachusetts, specifically zeroing in on zip code 02050. We've got a fresh stack of February 2026 data pulled from the MLS PIN and RPR public records. And honestly, looking at it, the numbers we're unpacking today are throwing off some seriously mixed signals.
They really are. I mean, if you look at this data set from one angle, it tells a very traditional story. But if you shift your perspective even slightly, it looks like a market in the middle of a total identity crisis.
Exactly. And that brings us to the central question we really need to answer today. When you look under the hood of this Marshfield data, are we still dealing with a dominant, highly competitive seller's market, or are these underlying metrics finally revealing a structural shift toward true buyer leverage? Now, when I look at the numbers, I see a market that remains strictly anchored in the seller's favor. The extreme, ongoing inventory shortages are still dictating the mechanics of everything, and we are absolutely still seeing aggressive bidding wars for properly positioned homes.
See, I'm coming at it from a completely different angle. While I acknowledge the inventory constraints on paper, I am seeing a very clear shift toward the buyer. You have severe spikes in days on market alongside some really notable month-over-month price drops. To me, that indicates buyers are finally demonstrating systemic resistance to these elevated valuations. The leverage is quietly but decisively changing hands.
Well, let's start with the foundation of my perspective, which is the sheer structural scarcity present in Marshfield right now. The market currently has a microscopic 1-month supply of inventory. And for anyone listening who doesn't track real estate metrics daily, let's just break down what a 1-month supply actually means.
Yeah, it's an important baseline.
Right. It means that if no new homes came on the market starting today, every single house currently for sale in Marshfield would be completely bought up in roughly 30 days.
Right. And to put that into context, a normal, balanced market, where neither the buyer nor the seller has a distinct advantage, usually operates with about a 4 to 6 month supply of homes. So a 1-month supply is exceptionally tight.
It is incredibly tight. Furthermore, that 1-month figure is actually shrinking. It's down 15.25% month over month and down 13.8% year over year. I mean, we are looking at an incredibly high absorption rate right now. The speed at which available homes are being bought up is vastly outpacing the new ones coming onto the market. And when you have an absorption rate that aggressive, basic economics dictate that pricing power remains fundamentally anchored with the seller.
I see why you point to that, but, and this is where I think we diverge, the structural scarcity is actually masking the reality of current buyer behavior. I agree that the inventory numbers look anemic, but if a 1-month supply truly meant sellers held all the cards, homes would be evaporating the second they hit the market. Instead, what are we seeing in the data? We are seeing a massive, undeniable 246.15% month-over-month spike in median days on the market.
Yeah, the days on market jump is certainly the most jarring metric on the spreadsheet.
It is staggering. Properties are now ballooning to a median of 45 days before moving. Think about what 45 days on the market actually feels like for a seller. For the last few years, a seller could put a sign in the yard on Thursday, leave for the weekend, and come back to 10 offers on Monday. Now, they are sitting through an entire month of open houses. They are keeping their house immaculate for weeks on end. They're enduring lowball offers. They're doing price reductions.
That's an interesting point, though. I would definitely frame it differently. Because a 45-day median time on market might feel like an eternity compared to the absolute frenzy of a few years ago, but by historical standards, a month and a half is still a relatively healthy transaction timeline.
Healthy? Maybe, but certainly not indicative of dominant seller leverage.
Well, we also have to contextualize why that spike happened. We are looking at February data for a coastal New England town. What we are likely seeing with that 246% spike is a seasonal holiday lag. The Northeast market in February is quite literally thawing out from the winter weather. You combine that seasonal friction with a specific overhang of incorrectly priced homes, and you get a heavily distorted median.
I'm sorry, but I just don't buy that. You cannot dismiss a 246% month-over-month spike as a mere seasonal thaw. Seasonality accounts for maybe a 20 or 30% fluctuation in days on market. It does not account for a near tripling of the time it takes to get a property under agreement.
So how do you explain it, if not seasonality?
It's a profound psychological shift among the buyers. They are looking at the available inventory. They are running the mortgage calculators with current interest rates, and they are simply balking. The carrying cost on an $800,000 home today is vastly different than it was a few years ago. If buyers were truly desperate, if they were entirely driven by that 1-month supply you mentioned, they would absorb even the slightly overpriced inventory out of sheer necessity.
But you're saying they aren't desperate.
No, they aren't. They are choosing to wait. They are choosing to negotiate. And that leads directly to the pricing disconnect we are seeing across the board. Sellers are clearly overestimating what the market will bear right now. Look at the MLS data. The month-over-month median sold price dropped sharply by 14.12%, down to $730,000.
I don't disagree that a 14% drop in the closed median price is a noticeable dip, but we have to be really careful with how we interpret sold data.
How so?
Because sold data is fundamentally a lagging indicator. The properties that actually closed and recorded in February were largely negotiated, inspected, and put under agreement back in December and early January. Historically, that is the absolute slowest, least competitive window of the entire year. To understand where the market leverage actually sits right now, today, we have to look at the leading indicators.
You're referring to the pending and active listings?
Exactly. The leading indicators are painting a very bullish picture for sellers. The median list price for active listings is up 4.4% to $834,500. And even more compelling, the new pending listings, meaning the actual contracts that buyers and sellers are signing right now, saw a massive 17.2% jump in their median list price, hitting $784,000. This tells me that the drop in closed prices you're focusing on was just a brief, holiday-driven anomaly. The higher-tier inventory is already moving again, and buyers are stepping right back up to the plate.
That is a compelling argument, but have you considered that an increase in asking prices does not automatically equate to an increase in buyer willingness? Just because the active median list price is up to $834,000 doesn't mean buyers are actually going to pay it. It often just means sellers are still stubbornly holding on to yesterday's expectations.
But the pending prices are up 17% as well. Those are actual contracts being signed.
True, but let's look at the broader, unfiltered picture. When we step away from just the MLS, which is the highly polished retail side of real estate, and incorporate the RPR public records data, the narrative shifts dramatically.
Let's quickly define that for the audience, just so we're on the same page. The MLS, or Multiple Listing Service, is where real estate agents post properties for sale to the general public. RPR, or Realtors Property Resource, aggregates all public county records.
Right, so the RPR data captures a much wider net. And when you look at that wider net of all transactions in Marshfield, the median sold price absolutely plummeted 35.8%, down to $462,500. That suggests there is a massive undercurrent of transactions happening well below the premium prices we see heavily marketed on the MLS.
Okay, let me stop you right there, because we have to acknowledge the limitations of using sweeping public records data to gauge retail buyer leverage. Public records include everything. That means off-market family transfers, distressed sales, teardowns, and private deals that never even saw the open market. While a 35% drop down to $462,000 sounds terrifying for a seller, it is heavily skewed by non-retail transactions. Come on, you can't use an off-market transfer between siblings to prove that a retail buyer has leverage in a traditional open house setting.
Okay, fair. That's a fair distinction regarding the RPR data. But even if we completely throw out the public records and focus purely on the retail MLS sold report for single-family homes, the buyers are still flexing their muscles. Let's look at the sold-to-list price ratio.
Which is currently sitting at 97.3%.
Exactly. And just to clarify that metric, the sold-to-list ratio measures what a home actually sold for compared to its final asking price. A ratio of 100% means homes are selling exactly for what the seller asked. Anything over 100% means bidding wars. Anything under means buyers are successfully negotiating the price down.
Right, so at 97.3%, the data is telling us that, on average, buyers are chipping away at the asking price. In a market where a house costs $700,000 or $800,000, a 2 or 3% discount is $20,000 staying in the buyer's pocket. If we look closely at the single-family listings sold in February, 4 out of the 10 properties in the main dataset went for under their asking price.
I see the examples in the data, yeah. Take 74 Cherry Street, listed at $599,000, but it sold for $557,000. Or 100 Gotham Hill Drive, listed for just under $700,000 and closed at $680,000. These aren't anomalies. These are proof of a market where buyers are looking at the inspection, looking at the interest rates, and successfully pushing back. When nearly half your market is selling at a discount, the seller does not have absolute leverage.
I'm just not convinced by that line of reasoning, because you are aggregating the data in a way that obscures what is actually happening on a granular property-by-property level.
How so?
Because we are looking at a classic tale of two markets. When a property hits the sweet spot, meaning it is well-maintained, properly staged, and priced accurately for its specific neighborhood, the seller's market is as fierce and immediate as it was at the peak of the pandemic. You cannot ignore the properties that absolutely blew past their asking prices this month.
I know there were a few standouts.
More than a few. Let's look at 3 Birch Road. They listed that property at $1,299,000. It closed at $1,375,000. We are talking about buyers voluntarily throwing an extra $76,000 on top of a $1,300,000 price tag. Or look at 4 Fletcher Drive, listed at $649,000, escalated all the way to $725,000.
Those are significant premiums, I'll admit.
And it's not just specific price bands, it's specific neighborhoods too. Look at Brant Rock. We saw 68 Marshall Avenue listed at $579,000, and it sold for $611,000. Out of the 10 sold properties in the primary dataset, yes, 4 went under asking, but 4 went significantly over asking. The ones that captured the market's attention did so with tremendous velocity and premium pricing.
I actually agree with you that the market has become highly fragmented. It absolutely is a tale of two markets right now. But your conclusion that this fragmentation means we are still in a strict seller's market is exactly where we diverge.
Why doesn't an $80,000 bidding war prove seller leverage?
Because in a true dominant seller's market, a rising tide lifts all boats. Think back to 2021. Sellers could put a poorly lit photo of a house with a leaking roof and original 1990s appliances on the MLS, and they would still trigger a bidding war within 48 hours. The fact that buyers have become intolerant of deferred maintenance and aspirational pricing is the exact definition of buyer leverage.
See, I wouldn't call it leverage. I would call it a return to standard market fundamentals. Buyers want value for their money.
But that requirement for value is the leverage. Buyers are now dictating the terms of engagement. They are walking into open houses and saying, if you want my $800,000, the house needs to be absolutely pristine. If it isn't pristine, or if the seller is asking a premium for a project house, the buyers are completely content to let it sit on the market for 45, 60, or even 80 days until the seller capitulates and drops the price.
I hear that, but let's remember the underlying value appreciation overall. The median estimated property value in Marshfield is still sitting at an impressive $808,420. That represents a steady 3.6% year-over-year increase. The equity is holding strong.
The equity is holding, yes, but the days to offer are extending. The MLS sold report shows an average of 33.5 days to offer. That means a seller has to endure an entire month of showings before they even see a viable contract. You simply cannot call that a dominant seller's market. A dominant seller's market is characterized by immediacy. Right now, buyers have the breathing room to do their due diligence, inspect the property thoroughly, and negotiate terms.
It's true that the immediacy isn't completely universal anymore. If a seller misses the mark on their initial pricing strategy, the market will punish them with days on market. But if they do their homework, they are still rewarded with multiple offers. Let's look back at the strategy for 68 Marshall Avenue in Brant Rock. Listing at $579,000 was an incredibly strategic entry price for that coastal enclave. It was designed to capture maximum visibility, and it resulted in a quick escalation to $611,000.
That is a textbook example of smart pricing. But notice what that seller didn't do. They didn't list it at $650,000 just because the town only has a 1-month supply of inventory. The seller recognized that there is a ceiling to what buyers will tolerate right now. Even the success stories require sellers to be highly pragmatic. They have to concede to market realities in ways they simply haven't had to in years.
That is a fair distinction. To sort of summarize my perspective on where we stand today, the underlying mathematics of the Marshfield real estate market fundamentally prohibit a massive shift to buyer dominance at this time. When you are operating with only a 1-month supply of inventory, the basic economic law of supply and demand dictates that sellers hold the structural advantage. While we are certainly seeing slightly longer days on market and some pricing stabilization, the 17.2% jump in pending list prices proves that the buyer appetite remains voracious when the right product becomes available.
And from my vantage point, the data shows a clear exhaustion of buyer tolerance, which establishes a very real foothold of leverage for purchasers. You cannot ignore a 246% spike in median days on market, coupled with a 14% drop in month-over-month closed prices and a sold-to-list ratio of 97.3%. The narrative on the ground is undeniable. Buyers are no longer rushing blindly into transactions. They are negotiating, they are forcing price reductions on overvalued homes, and they are demanding pristine conditions for premium prices. The urgency that once completely defined this market has dissipated, forcing sellers to adapt to a much more balanced, demanding reality.
I think where we ultimately find convergence today is in the profound nuance of the Marshfield market. The days of treating this area as a monolithic environment are definitively over. It is a highly fragmented, property-by-property reality. Hyperlocal factors are dictating everything. The specific neighborhood dynamics, whether you are looking at a beach community like Green Harbor versus an inland neighborhood, the precise condition of the home, and the accuracy of the initial pricing strategy will entirely dictate whether a home sparks an immediate bidding war or sits languishing for over a month.
Absolutely. Anyone reviewing these February trends must look way beyond the broad, simplistic labels of a buyer's or seller's market. To truly understand where the leverage lies in any given transaction, you have to examine the specific price bands, the condition expectations, and the micro markets that apply to that unique situation. There is just so much more complexity to explore in this data.
If you have any questions about this episode, or if you are thinking about buying or selling a house anywhere on Boston's South Shore from Southie to Sagamore, give Jim Aldred a call. He would love to speak with you. Jim believes that people in transition often feel anxious about buying or selling a home, and he provides them with the guidance and security to help your family move on smoothly. Thanks for listening, and catch you on the next episode of The Pink Door Podcast.
Thank you.